Hello everybody and welcome to the second session of the NZX's Virtual Global Dairy Seminar for 2020, proudly brought to you by StoneX into food and global dairy trade. Today's session is brought to you by StoneX, and in this session we're going to have Jason Bray, the Head of Dairy for Asia and Oceania for StoneX, and he's going to talk about the mechanics and benefits of index-linked physical pricing and positioning using NZX derivatives and the role of the exchange for physical or EFP trading facilities. So lots of good meat in there for those of you who are traders. Before we start, if you haven't already, please make sure you download the NZX's event app to take advantage of our networking ability so you can connect with all of the other attendees, of which there's over 800. As well as access the Q&A and live polls for each session. You're going to also find the recordings there, as well as the speaker and sponsor details. So we've just posted a link in the chat box on the GoToWebinar application, which will take you to the event in Socio, the web platform that we're using, and from there you can either use it in your web browser or you can download the app. So you'll find there a section that says Q&A and live polls. If you click in there, it will bring up a section of where you can ask questions. The question functionality is turned off in GoToWebinar. You have to ask questions via the app, so join in there. If you've got any questions for Jason today, just chuck them in the app. We'll try and get through as many as possible at the end of the session. The good thing about the event app is that you can vote up questions that you see there that you like the look of, and the more votes that they get, the more likely they are to be asked. So get asking and get voting. Attendees have been muted. This shouldn't impact you hearing us though, but if you are having problems hearing us, there's some troubleshooting there on the left of your screen. Run through those, and if you still can't get your audio to work, don't worry, there is a recording. This is going to be recorded, so you'll be able to pick that up afterwards if you've missed anything. So that's enough from me. From now, I'll hand over to Jason, and he's going to kick off today's session.
That's great. Thanks very much, Nick. You can see the presentation okay, I'm hoping?
Yep, we've got it loud and clear.
Wonderful. Okay. Right, so thanks very much again for the intro, and I'm sure Eric gave everyone a big welcome in his GDT presentation earlier, but just want to echo that, big welcome everyone, and thanks very much for joining wherever in the world you may be. Yeah, also thanks to Jess, Nick, well, the two Nicks, I guess, and the whole team at the NZX for organising, what will no doubt be an event just as successful as previous events, however, under much more extraordinary circumstances. So thanks, everyone's effort is really appreciated. So moving right along, just a quick bit of legal stuff. So I just need to highlight that investing in exchange traded derivatives and OTC products involves substantial risk and may not necessarily be suitable for investors. Hence, we would strongly suggest that everyone seek independent advice before engaging in any. Furthermore, the information contained within this presentation is in no way a recommendation to trade or engage in related transactions and does not create any form of binding obligation on any of the StoneX group of companies. So a little bit about StoneX, formerly known as INTL FC Stone. So in a nutshell, StoneX, we're a leading independent financial services company. We connect more than 30,000 clients around the world with over 40 exchanges and hundreds of liquidity sources. We're publicly listed on the NASDAQ under SNEX or SNEX, very close to SNEXy, and some of our key metrics are on the slide. However, all are publicly available, so do get on either our website or the NASDAQ website and check them all out. Here at StoneX, we offer a unique capability to provide efficient and transparent execution via both high touch and electronic means. We're a leading provider of incisive market intelligence as well as post-trade settlement and clearing in nearly all markets, including dairy and a lot of other asset classes as well. Now, on the topic of dairy, we're very proud to have been at the forefront of the development of the NZX dairy derivatives, having traded the first ever NZX contract. We also did the millionth contract, or the millionth lot, a little over a year ago. Furthermore, we're a majority clearer and a major trading participant as well. So, overall, I know that our dairy-specific boots on the ground in Singapore, Dublin, and Chicago, we're all excited and looking forward to continue to help facilitate and lead the growth of these extremely useful products. So now into the presentation itself. So we're just going to start off looking at index-linked pricing, and to put this topic into some sort of context first. I mean, ultimately, any business transaction or any investment ultimately comes down to this equation, with the goal, or the ultimate goal, being to maximize profitability and generating wealth. Hopefully for ourselves, but if not for ourselves, for management and shareholders, or someone that pays our wages. Ultimately, we just want to turn, what little cash we do start off with into a much larger amount. A simple way of looking at this in the physical world, whether you're a processor, a trader, end user, or anything in between, is we're ultimately buying a raw material from a supplier, sticking that into a factory, we're converting that into some sort of a saleable product, for example, an infant formula, and our goal is to maximize our wealth by optimizing one of either the dashed boxes. So whether we have a lean, mean manufacturing process and an optimized supply chain, minimizing cost of goods sold, or whether our sales force just go beast mode. And if you don't know what beast mode is, just let me know, and I'll send you a video of what my daughter does after I turn an iPad off. Ultimately everything is really just coming down to, or very frequently, optimizing this equation just comes down to price efficiency of one form or another. However, when we try and do that, sometimes the stars just don't align. When we're trying to optimize business transactions and generate the best possible margin. And this is due to this dynamic whereby buyers obviously want these sorts of pricing down the bottom here, and sellers are looking to position at highs of the market. Historically low market prices are great for buyers. However, not really much use if no one's going to sell to us at that level. What can we do about it? Well, what often happens is buyers and sellers really just often to revert to one of three strategies, i.e. looking at spot transactions, maybe cash or carry specifically for a buyer, or some type of long-term flat price contract. And look, there are a number of benefits and some things that are perhaps not so beneficial concerning these. I think the main benefit really, and having a background in as a buyer, is probably the top one on the left-hand side here. So, we get the opportunity to enjoy and maintain and enhance existing supplier relationships, and when we have a long-standing relationship with people, it just makes business easy, right? Also, from an operational point of view, familiar product performance and branding is a huge help, especially to those manufacturing guys. And look, at the end of the day, when the physical positioning, if we're buying exactly what we need, well, the peace of mind aspect of that is huge as well. Better a bird in hand than two in the bush. However, if we're taking a physical position, if we're looking to cash and carry, if we're buying a significant amount of product now with a view to store it and then to use at a later point in time, and it comes through, a number of other, costs come through as well, such as, we've got to finance that inventory, we've got to house it somewhere while we're warehousing it. there's potential for inventory depreciation and possible degradation in quality. Especially in Southeast Asia, where every day the temperature seems to only vary between hot and really hot, not to mention the humidity. But look, when we're engaging in long-term contracts as well, price and flexibility can be an exceptionally big risk, especially when we've got a significant amount of market volatility. We don't want to be forward locked in at the highs of the market, only to have it crashing back down. And likewise the other way around. Furthermore, not everyone is a big swinger in this market. There are a number of us that may not even have the buying power or the ability to take on a position that they necessarily want. So, what's the answer to all that then? What can we do in order to balance the good and some of the not so good aspects of physical positioning? And look, I didn't really want to say, I didn't want to say bad aspects, because a lot of people have been very successful in doing just that and generate a lot of value from physical positioning. But what I really wanted to highlight was that word balance, with the hope that the following concept will create some sort of framework or awareness or discipline that reduces the emotion in trading decisions, whether that be buying or selling, which is all critical in implementing any sort of successful risk management plan. And so to flesh out the answer to that, what if we had an agreement whereby the benefits of a long-standing agreement with a counterparty is enjoyed, i.e., a seller having a buyer that commits to buying and a buyer that has a seller that commits to selling, without having to endure some of the drawbacks of the physical long contracting that we discussed in the previous slide. Now, the solution that we'll work through is an index-linked physical contract, which ultimately is a commitment to buy and to sell. But then we use the NZX futures to replace the price positioning we'd usually enact by stocking inventory, going really long or going really short at specified points in time. So an index is ultimately just something that tracks the financial performance of an asset class or a subset of an asset class. So it's basically just a floating rate, similar to a mortgage, how we fix and unfix and keep portions of mortgages floating, but obviously with commodities rather than real estate. So the intent of an index really is that hopefully it becomes some sort of a fair representation, if it isn't already, or a benchmark or an efficient benchmark for the underlying that allows business transactions to take place, incorporating it or around it. Now, before going into an actual example with some figures, some of the key benefits of replacing physical positioning with NZX trading, futures trading, I should say, have been highlighted in the boxes there. So all futures contracts are, at the end of the day, is a temporary substitute for a future cash or physical transaction. So all the aspects of futures contracts obviously have to mimic what goes on in the physical world. There are a couple of key differences in that, though. One being futures contracts are obviously traded on a futures exchange. The great thing about futures exchanges is that they're easily accessible. It's an easily accessible market, obviously through a broker. However, they bring buyers and sellers together that all have different investment objectives that come together to transfer risk amongst each other. It also provides a level of transparency, of price transparency, that is very often not seen in the physical world to a certain extent. Now, the point 3 there, in terms of delivery, the futures are cash settled, which has both benefits and drawbacks. One of the benefits being, we don't have to deal with physical product, or we delay having to deal with physical product yet still enjoy the benefit of forward locking in a price in dealing with futures contracts. Okay, and we'll come to a little bit more of that concept a little later on. Lastly, just down the bottom there, number 6 with the cash forward contract, relating to financial integrity. Obviously, individual counterparty or counterparty risk in a bilateral physical contract is pretty much as good as the word of your counterparty, whereas in futures there's a centralized clearing model which ensures that the risk of counterparty default risk is mitigated or eliminated. So there are a couple of drawbacks, obviously, and we can't ignore those. One being that whenever we deal in futures contracts, there's the concept of margining. If anyone's unfamiliar with the concept of margining, please do shout out and let me know. I'd be happy to discuss in more detail. There is a solution around that with regards OTC offerings, but the opportunity to extract more value, I think, out of a transparent market, can sometimes, I guess, be a little bit limited if the market is so transparent. However, the benefit when we observe big market moves and huge market volatility, such as what we've just gone through over the last 6 months, would far outweigh any sort of negative connotation associated with having pricing transparent through an index. So looking at the example now, so we are assuming that we're going back in time to August of this year, whereby we're an end user buying regular spec whole milk powder, and we consume roughly 300 metric tons a month. And now we commit to an index-linked contract with our favorite supplier for or to take delivery of 100 ton a month. Okay, now I guess just for further clarity upon reading this out loud, this may be a little bit confusing. However, all we've done is we've negotiated a physical supply agreement with a supplier in August for 100 ton a month. Now, given that we're confident that we'll consume at least that amount over a period of time, and the rest of the volume, we're likely to consume, we'll just assume that we'll physically position like we always do. Now, we've got an index-linked agreement in place before October. Now, come October, we've got a chance that we'll be short product, and when I say short product, I mean that we'll likely have a client order requiring raw materials, i.e. the whole milk powder regular, in the second quarter of 2021. When we have that sort of an order, obviously that generates a risk, and we will need to do something about hedging that risk. So what do we do? Right, so first and foremost, if we consider the delivery or the ETA of the product that we need, so in the chart or in the table, we've got a physical ETD and in brackets an ETA. So if we work back from the ETA being Q2 2021, we can assume that the physical shipment from our supplier would likely look like a March, April, May shipment. Now the corresponding futures month against those shipments is quarter one, right? Jan, February, March of 2021. That's because the futures settle to the winning average price of the C2 contract on GDT, and for example, a January future then gets pegged back to a C2 shipment, which is February, March ETD, i.e. April ETA in market. So if we look at the futures price for those respective months, we've got an average of 3010 for the period of time that we're considering hedging against a physical sale. So in order to answer the question as to whether or not we want to forward fix our procurement price by buying futures or not, is we ask ourselves some key questions, right? So, I mean, first and foremost, we just got to ask ourselves, is this better, or is that level of 3010 better than the physical market, or better than what the physical market can offer us at the moment? And more often than not, there will be differences between what the futures market are pricing and what the physical market's doing, and sometimes these will go in our favor. You know, if we're able to buy futures at 30.10, perhaps if we were to ring up a supplier ad hoc and ask for a shipment of product, we may get a price higher than that, so 30.50 or even 3100. Now, it also begs the question as well, is when that price is not in our favor, why don't I take a contrary position in the futures to help monetize that information? Maybe that's a little bit outside the realms of this presentation, but it's something that we need to think about nonetheless. Now, secondly, have we sold any of our finished material, i.e. have we sold any of the likely 300 tonne a month that we're likely to consume? That would require whole milk powder that then exposes our business. And I mentioned earlier, exposing our business just means if we forward sell the product, obviously we forward sell the product at a particular price, and then we've got to buy the raw material to cover that. So if we haven't actually sold the price, or if we haven't actually sold the product, or we're not looking likely to, then can we use this information to then set the target price to our own customers? I mean, personally, I think this is an extremely undervalued aspect of index-linked pricing. Again, coming from a buying role, if you've got someone that is, messaging you on a fairly regular basis, saying, this is my price list for product today, with the knowledge that if they sell it at that level, they can turn around and buy the futures at that price. It's a huge amount of value, I think, to a buyer that may not necessarily have time up his sleeve to look at futures markets, and it just goes that one extra step further in cementing relationships as well. Lastly, point 4, so all things considered, look, are we happy being long at this level? Does it meet long-term budget targets, or does it fit in with some sort of systematic buying program based on where historical price percentiles actually are? So on this point, we may just be happy forward fixing it without actually having a sale against it, purely on the basis of that there may be perceived upside risk in this market. So, having gone through COVID and everything, and all the impacts that's had on commodity markets, in light of everything that's going on, and I guess in light of or even with the knee-jerk reaction of pretty much every asset globally, every risky asset globally being sold off, we're seeing a really strong, a very strong bounce back that I think has caught a number of people by surprise. It certainly caught me by surprise, and even, I guess, more closer to home. We've had 2 GDT events previously that have proved that people are relatively happy at the moment to pay up for whole milk powder, given that it's really sitting close to long-term averages and long-term economy, sort of 3 to 5 years. So you can't go too far wrong, at least getting some coverage on at the current price levels. Furthermore, globally imports have seemed to be relatively strong. That soaked up a lot of the stock build that perhaps some of the major dairy exporters had done in quarter 2 of this year. But really, I think the thing that we're kind of looking forward to, helping, I guess, make this decision is really trying to answer the question, which is not an easy question, obviously, that, are we ever going to get back to pre-COVID demand and more normal demand patterns before government stimulus or any sort of government intervention, and kind of like supply chain security buying, etc. Whether demand returns to more normal patterns before that wears off. And I mean, the conclusion really is, maybe we are in for an uptick in prices in mid-2021, which would then justify, a buy or forward fixing at least some of our procurement cost at around 3,000, which is what's currently offered, what was offered in this example in the futures market. So apologies for bombarding everyone with a lot of info, but to round off the example, look, say our finished material client has agreed to a component price for that whole milk powder that we're chucking into that thing that we're selling. So they've agreed to a price of 3,200, and then based on some of the concepts discussed in the previous 4 points, we've decided to forward fix our floating exposure. So what we've decided was to ring up our broker and we've decided to buy 100 tonne a month at the prevailing futures price, which is a 3010 average. Okay. Now, in doing this, i.e., in actually forward locking in this price using futures by buying them, we are in essence creating an obligation. Okay, so any sort of hedging using futures or any sort of dealing in futures creates an obligation. It's not as stringent an obligation as dealing in the physical market or buying a significant amount of product, going long in the physical market, but it's still there and we need to be aware of it. Now that obligation is that at some stage we need to offset what we have done, right? So by offset, we mean if we bought futures, we need to either sell them back or we hold them to settlement. Okay. So just something to obviously take note of in this example here, where this slide is just showing the washout of this trade. So what we've assumed that we've done is the first step is that we've bought futures at a 3010 average for our 100 tonne a month, okay, and that's to forward fix the purchase price of the product that we've already committed to buy, but it was just a case of forward fixing the floating price or locking down the floating price with the supplier. We've assumed that we've sold the physical product to our end client at 3,200. Now, what happens when we come to actually take ownership of the physical product? Because we obviously need to still have physical product manufactured into a thing. So we are buying the physical at, say, for example, 3,250, which is a good thing for our hedge, perhaps not such a good thing for the finished material sale. And lo and behold, if we take ownership via global dairy trade, our futures match, or the settlement price of our futures will cash settle nicely against to what the physical price obtained on the GDT auction platform actually is. And we'll discuss that a little bit more once we look into the exchange for physical procedure as well. So the net effect of the trade is, if we buy something low and sell it for higher, we make a nice green net margin on that, while the reverse happens, which in this case has happened in the physical trade. So we bought futures to forward lock in our purchase price at 3010, and then we had them settle at 3250. So we've got a net margin of 190 once we balance that out with the opportunity cost of the physical transaction, where we sold the whole milk powder component, the finished good, for 3,200, yet we took ownership of that via GDT at 3,250 for a $50 metric ton loss. Okay. Now, when we are fulfilling the obligation that we create by dealing in futures contracts, we assumed in the previous slide that we were just going to take ownership of that by participating on GDT. But what would happen if we wanted to unwind this position prior to GDT actually settling? Now, providing that the index-linked supply agreement actually that you've got with your supplier actually allows for that, then in theory what you could do is before a GDT event, say for example if this is for the product that we wanted to buy in January, if we want to take ownership of that before participating in the GDT event in January, is that we have the same obviously initial situation where we're long the futures at 3010. We've sold the physical product to the component product and a finished material to our customer at 3,200. However, if we choose to take ownership, and this is a transaction that it would be negotiated directly with the supplier, say we're able to take ownership of that physical product before GDT at 3100, we may find ourselves in a situation where when we come to unwind our hedge, i.e. when we offset it by selling back the futures that we've bought, it may not be at the same price as what the physical contract actually is. Okay, so this happens due to a difference, or between, or I should say, this happens due to the presence of basis, which is a difference between the current futures price and the underlying cash or physical price. And the net result is that it just ends up as an inefficient hedge. So we've eroded a little bit of value by choosing to take physical ownership a little bit early. And these sorts of differences happen all the time. It's just the nature of markets that we operate in. However, basis is not necessarily a bad thing, and a smart investor will for sure be able to use this to their advantage. We did do a presentation on this concept last year, so if you'd like to learn more about it, please just do drop me a message. I'll be happy to share it. So when we're thinking about, or we're considering basis, an efficient hedge requires two things. It requires correlation between the physical world or the cash world and the futures, plus the liquidity in order to enact our hedge at the same level as the cash price. However, these things are not always prevalent. Okay. So I think probably the conclusion of that example has probably raised a few more questions than not. So apologies for that, but what it does do is it makes way to introduce the concept of the exchange for physical transaction, which helps optimize that very risk observed in the last slide. So some of the questions that are probably raised by that, the one that we just addressed. What if I don't want to wait until GDT to actually secure my physical product? What if I need it now, and what if my supplier is happy to supply it to me? Perhaps before being able to participate or buy that on GDT. And secondly, do I even have 100% certainty that I can actually access the GDT event to take ownership of that physical product and just let my futures cash settle? Because at the end of the day, not everyone actually has access or eligibility to participate on the GDT event platform. The third one, my whole milk powder specification is different to the NZX contract, and the NZX contract is a whole milk powder regular spec, hence why we used it in the last example. Can I still use the NZX dairy futures to hedge? Are they still relevant? The answer to that is a resounding yes, and the EFP process will tell us how. And the last one, can I use a different index? And by a different index, I mean an index different to the NZX dairy futures, or a different index to GDT? And can I still use NZX dairy derivatives for the hedging component of that transaction? Again, the answer to that is yes. However, we'll discuss it at the last bit of the presentation. Okay, so in light of the last slides, a nice little time to segue into EFPs, and apologies to start with a definition. However, I've taken this definition from the NZX Dairy Market Procedure, more specifically Procedure 9.2.1. Now, an exchange for physical is a mechanism that specifically allows for the simultaneous exchange of a futures position for a corresponding cash position at a price privately negotiated between the counterparties, or two counterparties, and the counterparties being a buyer of physical commodities and the counterparty that they buy that from, i.e. the supplier. So it's it's an alternative mechanism that's used to price physical dairy commodities, and at the end of the day, it just allows a participant to swap or exchange a futures position for a physical or cash or the underlying asset. So the existing offset mechanism, as we ran through in that example, really comes down to this, whereby we've got two market participants in the cash market. So we've got someone with long physical, that could be someone that's manufactured a product but hasn't necessarily sold it yet, or like in the instance of our factory making infant formula, someone that's short physical, right? And the risk being that if you're short physical, you need to buy it at some stage to then turn that into a thing to sell it to people. So your risk is that if you don't buy, or if you don't cover that exposure today, pricing may rally, and you may be purchasing that at a higher price in future. Right, so our hedge strategy against this initial risk position is that a long physical participant will, generally speaking, short futures, whereas a short physical participant or a short cash position will long or buy futures, as happened in the previous example. Now, again, whenever we deal in futures to hedge, that creates an obligation, and we need to offset that obligation. And so the current scenario, or the current situation, ultimately is that when we are short physical and if we're long futures, we at some stage have to buy that physical, i.e. we substitute out the long futures position for the actual cash or physical product that we use. Then our futures position goes through the motions of being cash settled if we choose to hold that to expiry. Okay, and the long, or the short hedger, i.e. the long cash guy, they will hopefully be able to sell that inventory at some stage and rely on the same cash settlement mechanism in order to offset their obligation. So the existing cash settlement procedure obviously relies on global dairy trade, the GDT option platform. However, again, when we're in the cash space, when they're in the physical space, it doesn't always make sense for us to just wait until physical GDT to actually book physical. You know, some of us can't actually access the platform in the first case anyway. And when this happens, or when your specification of product is slightly different to what the futures can offer, you're still incurring a little bit of basis risk. So when you're buying your physical product, you may not necessarily have the most efficient offset with the cash settlement mechanism that currently exists. So where the EFP, or the exchange for physical, comes into place is that we've got the same initial position and we have the same hedge strategy. However, our offset mechanism gets replaced by the EFP procedure. Now, looking at the original definition of what an EFP entails, it allows for two physical participants to pre-negotiate a physical deal, i.e. the person that's long physical will sell the physical, and they'll sell that to the person that buys it, because the person that buys it needs it, while at the same time they exchange their underlying futures position, which then goes to offset their hedge. So in this example, you've got the EFP mechanism, which has two components. So obviously the physical supplier selling to the buyer, and while at the same time their short futures positions get stuck to the buyer, or get given to the buyer, whereas the short physical guy, their long futures then get given to the supplier. The net effect of this, apologies, you have to excuse my my drawing, but the net effect of this is that we've got this thing cancelling out with this thing cancelling out with this thing, and then you've got the equivalent of what in essence was a cash transaction in the first place. However, by enacting the hedge in the first place, you were able to forward fix that variable supply agreement at a level that was desirable. So hopefully that's made some sort of sense, but now we're going to put a few numbers against that procedure And we'll use the same example as we've previously done. I'll just remove that scribble before we go into it. Right, so it's the same scenario. So it's August. We're an end user, but this time we need to buy whole milk powder instant rather than whole milk powder regular, right? So we commented previously that when your physical specification, if that doesn't exactly match the future specification, then you're going to be assuming a little bit of basis risk, right? There's a potential that when you come to offset your hedge, there's going to be a difference between the cash price and the futures price, which may result in some value erosion, okay? So now the index that we're looking at using accounts for that basis to a certain degree, whereby the supplier would probably likely still be willing to index link against the NZX futures or perhaps GDT, but they may just incorporate a fixed amount of basis in order to take advantage that it's whole milk powder instant rather than a whole milk powder regular. So moving on to the numbers then. So again, it's the same example, so it's the same numbers. We're buying whole milk powder instant this time. It's for the same period, Q2 21. We've got the same notional volume. The index that we were floating the physical purchase price against is the NZX futures or GDT, plus some sort of a fixed basis to account for the instantized nature of the whole milk powder. And we've still got the opportunity to lock in that variable agreement at an average of 3010. And again, we would go through all those key questions that we addressed, in the first example as to whether or not we go ahead and lock that in. So, we think to ourselves, is this better than what the physical market can currently offer? Have we already forward sold some of our finished material, and we want to fix our margin? Does that margin that we're fixing by buying futures against a fixed sales price actually make sense for the business? Or if the product isn't actually sold, knowing where we can potentially fix that today will then help us turn around and go to our finished material buyer and just say, hey, if I price this up at 3,200 or whatever now, i.e. the futures price plus a margin, would you be happy booking that today? All things that can be sort of a little bit of value add and enhance those supplier buyer relationships. And lastly, all things considered, are we happy being long at this level? So 2 points then to I guess consider when we move on into the next slide. So under the NZX derivative market procedures, i.e. the rules, the EFP price, and I'll bring up that diagram again just to highlight what that actually means. Right, it must be a similar value or quantity to the contract being traded and be reasonably correlated with that contract. Okay, so that just means that if we're looking to transact an EFP for whole milk powder, then the price at which is pre-negotiated between the seller and the buyer has to look like a sensible whole milk powder price. We can't just EFP a whole milk powder price at sort of $10,000 a metric ton because it suits a position or something like that. So it has to be a sensible, defensible price, and it's our job as a broker, obviously, to ensure that happens. And we're also going to assume before we go on to the next slide that when we come to negotiate that physical price, i.e. the price that that we're going to take ownership of the physical at, and we're going to offset our futures positions at, is pegged at the previous day's settlement of the futures market. Okay. Now, sorry, I just want to make one more point on that. So the beauty of an EFP is that no other participant needs to be aware of, or you don't have to disclose what index you're actually using. Furthermore, you don't have to disclose to anyone how you've arrived at that final physical physical swap price, I guess you could call it, right? That's all information that you know, is held between and, you know, negotiated between buyer and seller. Right? No one else has to take any sort of participation in that process, exactly like you would do in any other physical transaction. All right, so we've got our initial position. So we've got a short physical participant and a long physical participant. Then we're assuming that that each of these market players would have some sort of a hedge strategy. Now, we're the short physical guy, so we're coming from the long side in terms of the futures. We're assuming that we're forward fixing our procurement price at 3010, and there would be a likely hedge for the long physical, i.e. the supplier as well. However, a minor technicality here, the long physical guy may not necessarily have a short position to swap out. Okay, so I'll explain that in the washout. So again, our offsetting mechanism to offset the obligation that we've created by dealing by hedging using futures is that we're going to EFP this out. So we're going to EFP the futures and the physical prior to the settlement. Settlement being the GDT auction events. So what we are doing is we are in essence buying the physical from our supplier at 31.50. Right, so the seller's obviously selling that. And again, that's just a conversation that takes place directly between the buyer and the seller, right? No one else needs to get involved with that. But what both parties do need to agree on is that they will enact an EFP transaction based on this physical deal, okay? So once that's all agreed upon, then both counterparties, in order to transact an EFP, will then need to inform their respective brokers that this is going to be a transaction that will be EFP'd through the NZX. It's a very, very straightforward, a very simple process. But yeah, we do need to you know, make sure some boxes are checked before it actually gets accepted by the exchange. So in any case, they've agreed to take ownership of the physical product at 31.50. The seller's selling it at 31.50, and then the second component is that the positions then get swapped. So the this hedge here gets offset by the short futures that we receive, and then on the other side, the short futures that the long physical guy had would be offset by this long futures position as well. So again, the key aspects, so the EFP price matches the futures price 100%. This process, i.e. the physical process, is the same as any other pre-negotiated contract. Well, not pre-negotiated contract, the same as any other physical contract negotiated between a buyer and the seller. It's just that it gets processed, or the derivative side of the transaction gets processed by the exchange. So I mentioned that you know, the long physical participant may not necessarily have a derivatives position. And so in essence, what they would get out from enacting this is that they would have a net long. Then lastly, this price here would never actually be disclosed by the counterparty or to the counterparty either, obviously. So yeah, so then when we, I guess, look at the final little washout in terms of the numbers and the margin achieved. So to wrap it up, we've offset our 100 tonne a month hedge. The hedge was for an index-linked physical contract with a view to forward lock-in pricing, because it made sense to do so. Yet once we created that obligation by dealing in futures, we now need to offset that, and we're offsetting it by taking ownership of the physical via the EFP mechanism. So we were long futures at 3010. We sold the finished goods at 3200. We enacted the EFP at 31.50. Okay, and that's the same price that our futures will offset at as well. So at the end of the day, we've made $50 margin on the physical side of the business. We've achieved a nice margin in the futures of 140. So the net margin secured is 190 a metric ton, which is exactly the same as what we had previously in that very first example. So takeaway message is that there's zero slippage in unwinding our hedge, which is a very, very good thing. We've essentially eliminated the basis risk, yet we've still been able to enjoy the benefits of being able to, negotiate a physical deal with our key suppliers, be able to take ownership of the physical product that we're going to need to buy anyway, without having to wait for a GDT or whatever settlement event. So plenty of flexibility that the structure actually offers. Okay. Okay. Now I mentioned that I would just very quickly touch on the concept of the derivatives rule and the requirement at the bottom there being reasonably correlated. So I mean, the great things about EFPs really is, can boil down to this exact statement whereby, there are no limits on the type of physical or OTC swap being exchanged for a contract via an EFP facility. And so that solves the issue of, say, for example, buying a whole milk powder regular spec versus a whole milk powder instantized spec, and it makes the futures, perfectly viable and relevant tools in order to hedge any of the GDT specifications on offer. However, they must be of similar value or quantity, i.e., we can't make a silly physical transaction just for the sake of that. It's a big no-no to the contract being traded, and they must be reasonably correlated. So reasonably correlated infers that we don't need to necessarily use the NZX dairy futures as 100% of the index. We don't necessarily need to use that. We can use some other index if it better suits the counterparties to the physical transaction, i.e. the buyer and the seller. Yet we can still use the NZX dairy futures. When we come to enact the EFP, obviously the purchase price still has to be, or the final purchase price needs to be in some way, as it's stated there, reasonably correlated with the NZX futures market. However, it's not a mandatory requirement. Okay. The great thing is that, again, the index that's agreed upon between the buyer and the seller is completely at their discretion. At the end of the day, you just want to have some sort of agreement that's flexible, while at the same time being able to enact quickly in forward fixing either procurement prices or sales prices when the opportunity presents itself. And the EFP mechanism is a great way for doing that, and it solves a lot of potential issues or potential challenges that are involved in doing what a lot of us currently do at the moment. So just some final thoughts to take away. I've probably discussed a few of them already. So the take-home message, an EFP just converts a position, right? It converts that long futures position into a long cash position, while eliminating any of the risks associated with basis. So it's at the end of the day, it just provides a better link between the futures market and the underlying cash market. So at the conclusion of the last example, we mentioned there was zero slippage on exiting the hedge prior to settlement when using an EFP, in comparison to exiting the hedge and then taking ownership of the physical separately. It's relevant for non-NZX contract spec products. The index-linked pricing mechanism between a buyer and the seller, again, it just generates that commitment between the two, the commitment to buy and the commitment to sell. So it provides that framework from the get-go, and then the EFP enacts it to offset that obligation that we create when we deal in futures to lock in the physical procurement price. Lastly, and someone consider more importantly, it also generates a global dairy trade plus NZX exposure, and by exposure, if the index-linked price is pegged against the NZX dairy derivatives that settle to GDT, you can still generate that pricing exposure if you want to, when your access to the GDT platform isn't necessarily guaranteed. Which again, just another feather in the cap, just another nice little mechanism to help us achieve our strategic investment and supply chain objectives. So obviously the benefits don't come without challenges. First and foremost, in order to actually transact an EFP, both parties must have a futures account. Secondly, there is still a negotiation step with the EFP, and both parties must mutually agree to actually transact the EFP in the first place, otherwise it won't necessarily happen. Which, I mean, look, that can be a good thing for some people. You still have those lines of communications open, and actively promoting the EFP as a way to take ownership of a product can be, or would likely be considered, another value-add proposition between a supplier-buyer relationship, and it's also a way to to perhaps further monetize it as well. Dealing with futures obviously requires the funding of a margin account. However, I did mention that under OTC offerings, that some of that burden can be eased. And yeah, just as a final comment from me, overall, I genuinely believe that this the EFP procedure, or the EFP process, it's great for markets that it sometimes can perhaps struggle with consistent liquidity. The liquidity in the exchange is at times absolutely fantastic, but as with anything, there are peaks and troughs, and this mechanism is probably a what I'd consider slightly undervalued way of addressing that issue. Yeah, I'll just close by saying thank you very much for everyone's time. Apologies if I've confused a lot of people. However, do reach out to me if there's any questions on the material, and yeah, we'll hand it over to Nick for Q&A.
Brilliant, thanks, Jace. That was awesome. Some really useful tools that hopefully our listeners can use. So we're going to move on to Q&A now, and remember, if you click on the link that's in your chat on the GoToWebinar app, you'll be able to, that'll take you to the NZX event application, and it's just on screen there now. If you go to live Q&A and polls, you can click on there and start typing in your questions. So we'll jump into some of the questions that we've got in there now. You can also click to like them, and that'll vote them back up. So I'm just going to jump to the second question there on the list, Jace, because it sort of relates to the EFP discussion that you finished on around for those who have got long-term agreements, long-term supply agreements for their purchasing of physical products. Do they need to have a clause in their contract to be able to execute EFPs? Is that the way that you would suggest they would go about it?
Yeah. No, I would. I guess in those last couple of slides, I was sort of referring to the fact that when you do choose to or want to transact, then both parties must mutually agree to actually transacting it, and you also need an account open with a broker in order to actually transact that. So because there is a negotiation phase to then both agree, all right, we're going to do this EFP to offset the futures hedge at the same level as what the physical purchase price is. I'm sure it'd save a lot of hassle by having that something embedded in there already, but it's not mandatory. Probably certainly help create a bit of structure, but yeah, not mandatory. But I generally would suggest that both people do it, so that when the time comes to actually transact it, both parties are already set up, both parties have accounts with a futures broker, and they're ready to go.
Cool. That's good. So we'll jump up to the most popular one there. So how do you think that the dairy industry can increase the amount of indexed linked pricing, and who do you think should be initiating that? Should that be coming from suppliers who have got product to sell, or should it be coming from buyers demanding it?
Yeah, I mean, I think it should be coming from both. I mean, it really, I think the person that, or the counterparty to which it probably benefits the most is probably going to initiate that conversation. But like anything, there are a lot of pros and cons with index linked pricing. Hopefully more good than bad, otherwise no one would do it. But trying to, I guess, just create awareness that an index linked price isn't just accepting a floating price and taking or becoming a price taker for something that in years gone by we may have just solely relied on our view of the market to be able to pick troughs and physically position around that. So sorry, I've probably digressed a little bit, but it's just about being aware that having an index linked price doesn't necessarily mean you're only going to ever take a floating price. The NZX derivatives are great tools that fit in really nicely with index linked pricing to price position your portfolio rather than having to deal with the physical aspects of holding onto inventory. So yeah, I think it's just about creating awareness, understanding what's on offer, buyers and sellers coming together and saying, hey, this looks interesting. What index do you think would benefit your business? This would benefit mine. Can we meet somewhere in the middle with a view that, we're at the end of the day, we would both be happy if worst case scenario is that we just take a fair, efficient market price for our product. Because at the end of the day, that's the downside. The downside is that, all right, well, I'm just going to take market price for the product, maybe an opportunity lost. Probably just creating awareness, I would think, would be the first thing. Yeah.
That's good. I think the other thing from my perspective is being able to enable buyers and sellers to be able to access different price points that their physical supply agreement, so they can get security of supply, but also be able to access different pricing by having two contracts listed for the same product, right?
Mm-hmm, mm-hmm.
Okay, so the next question there is around back to EFPs. So we talked about a little bit about audit there, or having to show the efficacy of the physical leg. Can you provide any kind of indication on what documentation is required from an audit perspective to audit that physical leg? What needs to be kept?
Yeah, for sure. Yeah, and it really just comes down to having a being able to defend. Well, you say defend the position, it sounds a bit ominous. It's I mean, any physical transaction is going to have some sort of a like a purchase order or some sort of sale agreement or something along those lines that will clearly outline the price that's paid for it, and as long as the hedge is in some way able to be pegged back with a reasonable correlation against where the the futures are pricing or whatever index you're using, then that is that would be deemed. It's my opinion that would be deemed to be an acceptable hedge. We sometimes for the likes of block trades and things like that, they need to be within like a bid-ask spread of a market or something similar, or just outside. But a lot of EFPs and other commodities get transacted, for example, at the previous day's close, and depending on where the market ends up opening the next day, can be relatively far away from the market. However, if you've got a bona fide hedge in place for a future physical transaction, and it's stipulated that that physical transaction is going to happen at whatever level, like the previous day's settlement or something along those lines, then that's a perfectly defensible position. So something along those lines, paperwork, purchase orders, those sorts of things that are fairly really available are usually acceptable. you know, with I guess just keeping in mind, yeah, that the the prices just can't get a little bit too out of control. You know, they need to be defensible. Yeah.
No, that's good. We've kind of answered 2 questions. Got 2 for the price of 1 there, Jace. That was good around pricing as well as documentation. So you've done very well there. The last question that we've got there on our list before we wrap up and just come up with what's coming up next. Just you know, can you give any indication to the listeners around how common index linked pricing is in dairy versus you know, and some of the other commodities that StoneX are broking?
Yeah, probably not as as common as some of the other, you know, more, I guess, established ags markets, or even softs, where, you know, you've got these contracts that are just so incredibly liquid, and you know, unwinding hedging or unwinding hedging positions through the EFP mechanism is just, you know, it's standard, it's business as usual. So it's probably just a case of market maturity. You know, the NZX is sort of, you know, we've all recognized that these are really valuable tools, and they're really good mechanisms that can take place, but you know, we just need to, again, just keep you know, promoting them, saying that it's out there. Not overly common at the moment, but there's a massive amount of you know, huge amount of opportunity, and plenty of benefits to go with it. So
brilliant. That is the perfect place to wrap up, Jason. Really, thank you very much for, you know, for all that work and putting together something that really captures a lot of really useful information for people. Up next, that's the last session for today, but we get really into the meat and potatoes tomorrow. 4 sessions throughout the day, and then the same again on the 15th. That's on Thursday. So if you haven't signed up to the app yet, jump in and do that. That's going to give you an opportunity to network and connect with the over 800 other registered attendees, as well as keep up to date with any information that comes out meanwhile. So lastly, a massive thank you to Jason and the StoneX team, who's jumped off now, but hopefully he's still listening. We really appreciate you doing everything you're doing for the support and growth of the NZX market. And to everyone who's still on and listening, we'll look forward to seeing you over some of the upcoming sessions. If you've got any questions about anything, jump onto the app and send them through, and we'll be able to pick them up and get back to you. Have a great evening, and we'll see you all tomorrow.
thanks very much, Nick. Appreciate it. Cheers.
Cheers, Jace. Bye-bye.